The 2026 market has maintained a consistent upward trajectory. The Dow recently crossed 52,000 for the first time, and the S&P 500 has set roughly 24 all-time highs this year alone. This momentum extends across global markets. Indices in South Korea and Taiwan are up more than 20% since January, and the rally has expanded to include small and mid-cap stocks that were previously lagging. Corporate earnings appear to support these valuations. NVIDIA reported $81.6 billion in first-quarter revenue, an 85% increase over the previous year, which has bolstered investor confidence in the tech sector. For retail investors, this creates a specific pressure. Those holding shares from the SpaceX IPO are currently deciding whether to lock in their gains now or stay positioned for further growth and risk a potential pullback. However, choosing between buying or selling based on these milestones is a secondary concern.
Fixating on index levels often obscures the mechanics that determine whether this growth is actually sustainable. To understand those mechanics, we have to look past the macro numbers and analyze the specific companies driving the S&P 500's performance. This chart compares the top 10 S&P 500 companies to the remaining index. 10 names generated 83% of this year's gains. Furthermore, a 69-year line graph of the Shiller-Cape ratio shows market valuations hitting an expansive level seen only once before. This concentration means index fund investors are no longer gaining broad market exposure. Instead, their portfolios are heavily tied to the performance and volatility of a very narrow group of technology companies. The way these companies are expanding has also shifted. The build-out of AI infrastructure is no longer being funded primarily by cash reserves, but through significant borrowing. This diagram breaks down the composition of a standard S&P 500 index fund to reveal its underlying debt. Hyperscalers issued $121 billion in bonds last year, 4 times their 5-year average, meaning index investors are carrying more corporate debt exposure than the surface numbers suggest. This increase in leverage is happening just as the macroeconomic environment becomes more restrictive. April core PCE reached 3.3%, indicating that inflation is re-accelerating rather than returning to target. The Federal Reserve is also facing internal friction. The new chair, Kevin Warsh, was confirmed by the narrowest margin in modern history, creating uncertainty about the central bank's future policy direction. Markets are reacting to this friction. Futures now show a less than 1% chance of a rate cut by the end of the year, while geopolitical tensions in Iran continue to exert upward pressure on energy costs. The combination of high corporate debt and the removal of cheap money creates a structural tension. If these forces continue to move in opposite directions, the current market framework will eventually face a necessary recalibration. The standard reaction to high valuations is to liquidate, but panic selling is rarely effective. Historically, the cost of missing the final stages of a rally is often higher than the impact of a 10% correction. Strategist Anmar Kamil suggests a different framework. Rather than tracking price milestones like 52,000 on the Dow, investors should monitor the underlying rules that govern how the market operates. This model contrasts superficial price levels with the economic regime. While investors focus on the static line of stock prices at the top, the shifting structural data underneath represents the actual regime. These underlying conditions dictate the market's long-term path, regardless of daily price movements. To manage this, Kamil identifies 3 specific indicators to watch simultaneously: core CPI data, the tone of the Fed under Warsh, and the credit spreads on AI-related debt. Navigating this shift requires a move away from chasing records. Trim concentration in top-heavy tech, maintain a steady investment schedule, and you can stay positioned while waiting for those 3 structural indicators to signal a genuine turn in the market.